session for inventories and cost of sales. Okay. Hope everyone is doing well. Okay, remember the first thing we got to talk about: identify the items that make up insurance inventory. Remember, it's not as cut and dry as what's in the warehouse. Yes, to a certain degree, but we gotta look at other items too. The company owns and holds for sales, no matter where they're located. We gotta take special consideration for goods in transit, goods in consignment, if it has been damaged or obsolete. You gotta look at certain things here. First of all, for goods in transit, should you count your inventory? Well, it depends. It depends on your shipping term. If it's FOB shipping point, yes, you do. Remember, that means shipping point, the minute you order it, it's yours. Transit is the opposite. It means until it actually comes into your warehouse, you cannot count it because it's not your good. Now, how it says good in consignment, that means you're selling a good for somebody else. The answer would be no. You do not report your inventory because even though, yes, it's in your inventory, yes, you are selling it, you do not have ownership of the good. So no, you do not count it for your goods, even though it's in your warehouse. Now, if it's damaged or obsolete, you would report it at its net realizable value if it can be sold. If it can't be sold, you just remove it from inventory. If you have $1,000 of items, gone. Now, if it can still be sold, you say, okay, it's $1,000. All right, maybe we get $600 for it. You would mark it down to its NRV, net realizable value. Now, the cost. Remember, inventory. Don't just think about inventory, just what you bought items at. Yeah, you include all the costs you need to acquire the inventory and prepare for it to be sold. Shipping costs, storage, insurance, any discounts and allowances take out. Everything you need to get it ready to acquire it, then get it ready to be sold. Now think about some internal controls when we take a physical count here. They'll have to match inventory items, pre-numbered. There's no inventory. To the people who do inventory count, they have another responsibility. Do second counts. Make sure everything's confirmed. Okay, look at different things here. It's inventory. Again here, take a look what's in inventory. Take out your unsellable goods. It's a destination. Well, the costs you need to get inventory for purpose. Again, everything from your costs, import duties, insurance cost. Again, inventory in a purchase system requires matching costs with sales. For the balance, inventory affects because inventory is an asset account, affects the balance sheet and also income statement when it becomes a cost of goods sold. Now, inventory has costs and decisions you gotta make. Items to include, which costing method to use. We can go over each one here. Now, we look at different systems here. First one, this is standard. This is going to be the same for all of us. It's okay, what units you acquire cost, what you sell, and what was your ending inventory. So we see here, we acquired 55 units. That's my goods available for sale. I sold 43. I have 12 units in inventory. Remember, this is standard. This is the same for each system we're going to go over. Now, specific identification, like the name says here, we specifically identify each item sold. So I can tell you exactly which item is sold. These are for your high-end items, your expensive items, like jewelry, cars, houses, boats. Now, FIFO is the opposite. Remember, we're going to calculate two things: your cost of goods sold and your ending inventory count. FIFO, we make an assumption, means the first ones, the ones that have been sitting on the shelf for a few weeks, those were sold first. So if those were sold first, what remains on the shelf goes to inventory, the ones that just got in. So we see right here, FIFO says, all right, give an example here. We sold 20 units. What cost though? If you notice, we start to get your cost of goods sold top to bottom. Take 10 at 91, 10 at 106 to count for 20 units. Come down here, we sold 23 units. Again here, we assume the earliest goods that we got were sold first. Start with the 5, and 18 at 115. LIFO is the exact opposite. This one says, nope, the goods that just got here, they just got on the shelf, they just got here today. Those were sold first. So those were sold first, ones that just got here, and are the most recent ones. The oldest ones, those are going to be the ones that remain in an inventory. Okay, so again, let's look right here. Same exact chart. We sold 20 units, but here we assume the cost of the last one, the one that just got here, 15 at 106 and 5 at 91. Okay, and for the 23 units, again here, the one that just got there, the 10 at 119, we had a count of 23 units and 13 at 115. Weighted average is an estimate. These are for things that are constantly changing price, like gasoline. So your cost of goods available for sale divided by units on hand. So we see right here, we got $2,500 worth divided by 25, $100 per unit. That's the same for both of them. Cost of goods sold and inventory balance. Next one now is $2,800 divided by 25. It's $112 per unit. Keep going. Now it's 114. Again, take the total cost divided by how many units we have. Again, we have 23 units sold, 23 at 114, and 12 at 114. Again, so the effects of the inventory methods for both financial and tax reporting. Now, each one gives you different, sales are the same problem, operating expenses. But again, the difference is going to be with your gross profit, income, your income taxes, your net income inventory. Which method best fits your company? We see here. LIFO gives you the highest cost of goods sold. It has the lowest net income, except it also has the lowest taxes. FIFO gives you the highest inventory. Remember, here we're assuming prices are going up. Now, does that always happen? No. But we make an assumption, and it's okay to make an assumption. Again, different advantage for each one. First in, it says better ending inventory count. LIFO, better match the cost of goods sold with revenues. And weighted average is if you have an item that's always going up and down in value, like we talked about earlier, like gasoline. Tax effects. I mean, if you pick one method, you got to stick to it. You cannot be changing. LIFO is a little bit better because they say it gives you pay less taxes. Consistency. If you pick one method again, you cannot be changing. Change very rarely. An example one. How many units you have in cost of goods sold and inventory, that doesn't change for any method. The lower value does. How many units does not. So identification, we saw this. Specific indication says exactly which units are sold. We know exactly which ones. I think about like say a car lot. An example here. We're doing FIFO, first in, first out. Now we're doing LIFO. Last one, weighted average. L cost to market. As we assume inventory must report at market value when it's lower than the cost. Okay, that means, when the cost gets lower than the market, we have to obviously adjust our costs. Again, it can be for each item, each category, or all your inventory. Again, here we see the total cost. Here, take the first one for example. We bought it for 170, but now it's only with 140, so you can mark it down to 140. Again, 50, now it's worth 60, down to 650, whichever one is the lowest one we pick. Now we have to adjust it from $220,000 we got to make it $190,000. And again here, best example, it cost $11,000, now it's $10,000. The adjustment goes to cost of goods sold, the difference. I mean, expense and inventory, you want to decrease it by the difference, which is $1,000 in this case. And yeah, it's very important to make sure you do them correctly because the errors can affect your financial statements. We see here, you understate your inventory, the cost of goods sold's off, net income's off. The good part is it'll net out. The bad part is it'll net after 2 years. So for 2 years, you're going to have incorrect financial statements, which is not good. Okay. All right, class. Let me know if anyone has any questions, all right? Thank you. Bye.